Welcome everyone to NRG Insights. If you're listening on Spotify or watching on YouTube, welcome. This is going to be a little bit different from our normal NRG Insights. We've already had the pleasure of Islay on before, but this one's actually about recession-proofing your business. And I thought it was really relevant to speak to Hugh and Islay from Enness Global, given that they actually started the last recession in a very interesting time, and obviously have grown from that and thrived from that. So first of all, welcome Islay and Hugh. Thanks for joining me.
Morning.
Thanks, Marcus. Hi.
Morning. So if you can cast your minds back to 2008, talk to me, for people that don't know, tell us about the start of the Enness journey and from that time.
Go on then, Hugh. I told this story last time, so you can try and match it.
I was literally just about to say, go on, Islay, you're good at this bit. So Islay and I were at Alexander Hall together, so Foxton's mortgage guys, and that was, I mean, like far bigger boom than we're experiencing now. If now it's a boom even. But what we noticed were the wealthiest clients were the ones who weren't able to access financing. So we were doing 20 mortgages a month for Mr. and Mrs. Smith, etc., etc. But we found that the wealthy Middle Eastern clients, Asian clients, Russian clients who were coming into London weren't being serviced. So we thought this was like the perfect time to start a business. So we probably were about as wrong as you're going to get. But I think what we did call correctly was obviously the niche that we were going into did exist. And similar to what's happened, kind of in the last 12 to 18 months, coming off the back of a crisis, it's obviously, there was inflationary pressures which kept pushing house prices higher and higher. So if you remember back that far, even in 2008, although everything was falling to pieces in terms of the economy, kind of asset values continued to rise. So it was Islay and myself. We had a sort of small, very small 2-person serviced office at the wrong end of Battersea Park Road. I remember it was actually 15 years ago on Sunday just gone. So I remember the first day very clearly that I came in and Islay was underneath the desk sort of doing all the computers and fixing it all up. And then about a week later, obviously there was a run on Northern Rock and everything came crashing down. I think obviously there's no kind of like really glamorous story here that in terms of like we rode the wave and actually we really thrived during this kind of like huge economic crisis. But I think obviously what we were very focused on the market that we were looking to service and what we wanted to do. And whilst we suffered massively, like a lot of people in that time, we were able to pick out a number of small deals and identify like clients that we wanted to work with consistently on a regular basis. And some of those people that, that we worked with in the first sort of 6 or 12 months from starting are still some of our best clients now or best introducers. So I guess with kind of one eye on, the kind of the name of the webinar in terms of recession-proofing the podcast, like there's no kind of magic wand when things don't go so well. But I think if you are an expert in your field, people will continue to seek you out. And we've taken a fairly hot.
Sorry, was there a point at the beginning when obviously timing wasn't brilliant, but was there a point when it just?
Who says timing wasn't brilliant, Marcus?
Say again?
Who said timing wasn't brilliant? Was that Hugh? Was it?
Yeah, I think it might have been me.
I mean, starting a business just before. Am I right in saying that your opening week was the week of the run on Northern Rock?
Yeah, roughly. We had our launch party in Annabelle's, just Hugh and I, and the AIB credit card that they gave us for no reason with no security. So the three of us had a really nice time, and actually all 3 people in that one enjoyed it. Hugh, going back to your comment.
Yeah, they did.
And then we woke up the next morning.
AIB less so in about like 24 months time. Yeah.
That's it. And then we woke up the next morning, picked up City AM probably on the way home really, and this kind of all this bad stuff's happening that we didn't really understand. So I think we started the day before. That's how I put it.
So would you say there was I mean, obviously you didn't panic, but do you think it refocused you because you've just come out of a boom? I mean, if you were doing well at AH, it was a relatively easy time to make money. Did the recession kind of
the bit that panicked me? I had a client who his name was Dan, and he worked at Bear Stearns, which is a kind of major investment bank that disappeared during that period, and he had one of the top offices in Canary Wharf, so they were at the top and he was at the top, and he was buying just building after building, flat after flat, and I had something like £18 million worth of mortgages with C&G, another bank that doesn't exist anymore. Yep. And the fees to us at that point, I don't know, £40,000-50,000 worth of fees, and C&G pulled all their lending and then all those offers at the same time. So I think panic's not the right word, but that's the bit where I just shit myself completely. I think that was a more appropriate disappointment. And then, so we were kind of the first 6 months. There was quite a lot of business because we had our pipeline, we had people doing things, we had people reacting and trying to fix their problems. And then very, very quickly, credit was turned off and banks stopped lending and offers were pulled and everything else. So I think that's the bit where we kind of, where it got difficult. But it wasn't a panic because, you know, back then it was the same as now. You've just got to keep going, right? You can't just stop, put your head under the desk. You've got to do something, because if you don't do anything, then you're just going to go the same as everyone else. So, yeah. And
in regards to, you obviously did like a vast array of weird and wonderful lending on lots of different things. Is that part of it where you had to find things to lend on? You had to find.
No, I think what happened, right? So what happened, and some of your older view, I think we're pretty old in the mortgage industry, it seems, at the moment, but some of the kind of older listeners will remember this thing of dual pricing. The banks would pay us a proc fee, and if the customer went direct, they would get the same rate. Now, as credit tightened, banks encouraged customers to go direct to them, not through a broker. So they started making products cheaper if you went into Nationwide and kind of cut the broker out. Or HSBC back then didn't pay proc fees. So there was lots of lenders that were lending, just wouldn't pay a commission. So we went, why don't we charge a fee and then use the banks that don't pay us a commission, because we're still doing the same service. We're just charging the borrower for advice and access instead of the bank paying us. So it wasn't, so I guess there was two parts. There was finding new lenders and there was finding customers that we could actually work with in that period.
I think that fee point's interesting because you do see it. I mean, we still fight against it now, but there are kind of major competitors, if you like, of ours, where you see it's just like a kind of race to the bottom in terms of what they're charged. And yeah, you probably see it as well in the recruitment world, but it's frustrating because you have people who, whilst you don't know them personally or even have any kind of professional ties to them, you'd hope that there'd be a sort of an acceptance of we're all in this together, and it's harder now to do a mortgage than it was like 6 months ago, or it takes a bit more work. That it's quite frustrating that we see sort of these people just sort of fall off a cliff in terms of what they're charged. I understand it because certainly the way a lot of they incentivize clients.
Do you not think that's relative to people panicking, like the race to the bottom?
I think a bit of a problem is that it is, like, let's say, you know, working from a sort of employer-employee model, there's little downside from an employee, like in our example, a broker just dropping their fees. Yeah. Like for them, it's one of like 6 or 7 or 8 deals that they do. They just win the business and they take a little bit less. Whereas we found that kind of when we drop fees or, you know, there's less, that it sort of contaminates really the whole business in the sense that now one of the huge strengths that we have and why we've seen revenue, profitability, all these things go through the roof in the last sort of probably 3 or 4 years is we have a database now of mature people who know what we charge. Like if Dave phones up and say I'm referred by Ben, it's like Ben's told him what we charge, there's no resistance. And so just when you start giving discounts, it just absolutely murders what you do. And I think you saw, as Islay touched on, we were able really to kind of just charge a bit more during that period because we knew we were going to do a bit less, and inadvertently sort of stumbled across.
Do you think it's relative to customer service as well? Because when it gets tighter next year, obviously these guys are non-fee charging, their margins are tight. So I think the non-fee charging probably leads to you know, the loss of brokers and that kind of thing, because it's just so tight, you're not making enough.
I don't know how
It's
you
all
can make money
volume.
not
It's
charging
all
fees.
based on volume, right? So it's a volume game. So you can do that if you're happy to make a 10% margin, and you're going to process a couple of 100,000 mortgages a year or whatever the numbers are. But if the volume reduces, then that goes straight to your bottom line. So that's the problem. But yeah, it's easy to charge nothing. I've been thinking, I've been away for a couple of weeks. It's pretty expensive. We should probably put our fees up, Hugh. Now seems to be the right time.
No, they what is it? I think I sort of read that the only single thing you have control of in your business from the inside looking out is what you charge. It's the only thing you control, like how people perceive your business, how they react to anything, like even if people are watching this, how they react to it. You have no control over whatsoever. So it's the only thing you control. And yeah, it's key. Like we've spoken about it, Marcus, in terms of if people resist charging, like paying fees now, yeah, I'd probably be a bit wary of doing business with them, not because like their circumstances mean they might not be able to afford it, but that's fine. You know, that's just not what we're chasing.
But there is a scale. There is a scale though, right? So if you're doing a product transfer with Clydesdale, which is one form, takes 20 minutes, there's not much you can do to charge around that piece of work. If you're doing, you know, a first-time buyer that works at PwC and he's buying at 40% loan to value in Chiswick, again, it's quite a simple marketplace. All you're differentiating on is price. The lenders are priced very, very similar. So the only thing the customer's got to differentiate on is the price of the broker. So as things get more complicated, then the price should go up as a result. So if you're dealing with simple customers, it's going to be quite difficult. Not simple, you know, the vast majority of the mortgage market is relatively straightforward. If you're dealing in that part of the market, it's going to be difficult to differentiate yourself and charge more as a result.
There is that, there are a lot less vanilla mortgages now, I think. I know obviously your guys are the completely other end of the spectrum, but
hang on, a limited company buy to let is not a complicated thing. That's a vanilla mortgage, right? There's nothing complicated about that. No, but it's only complicated if you don't understand it. The minute you understand it, it becomes not complicated. So limited company buy to let, it's the same as mortgages for self-employed people. You've just got to be able to read accounts and tax returns and then do the same thing. It's not, you know, it's not super difficult.
Because there's lots of people that don't get it and haven't learned it. So that's probably more an education thing to brokers rather than.
Yeah, that's not the customer's fault.
No.
He shouldn't pay more for that.
That's not the customer's fault. This is complicated. I'm going like it's not complicated. You just don't understand it, right?
So coming into the more challenging times as we expect to be, sort of back end of this year, beginning of next. Given knowing what you know and being through it before, what kind of can you give any advice to those newer brokers? Because don't forget, if you've been a broker for the last 7 or 8 years, probably the biggest issue you've had is that month we took off during COVID when we had a little look around to see what was going on. So is there any kind of advice that you can give to newer brokers? Of probably, you know, I'm speaking to people who are looking down the hatches, and I just think they need to speak.
I think that like the one thing that just stands out to me is there's an awful lot of debt in the system. So we've arranged lots of mortgages over the last 7 years. And when the recession comes, the customers don't just pay off their mortgages. They still have mortgages, right? And they still have debt. They might have a property value that isn't worth as much as they thought it was, or there might be some valuation issues. Those mortgages will get more expensive for the customer as kind of rates go up. So there's still a huge amount of work to do. So the recession isn't taking away any of that. There's still mortgages to do.
A little bit harder.
Yeah. There might be fewer mortgages, which means the market's going to get more competitive, which means all of those high volume, low margin brokerages are going to find it maybe a bit more difficult. But there's still lots to do. It's not going away.
Yeah.
I think it's speaking to clients as well. Like, I think there's so much focus in the industry on front end business that, like, kind of the only way you grow, and sort of we've built a business, if you like, and we've shied away maybe from that kind of estate agency. Now is the time to buy, they must take a mortgage, because that's probably when they've got the most people on them in terms of fee pressure, options, distractions. And so I think it's maybe, whilst you got to kind of feed the beast, if you like, and keep doing business and keep the lights on, it's maybe sort of just using an opportunity to sort of think, well, look, who are my best clients, right? Like, who are my top 10% of clients, which is what we focus on a lot, like our kind of gold list, if you like. And right, what is it about those top 10% of clients that makes them exceptional for us? Maybe it's they do lots of business, so you have multiple buy-to-let landlords, or in our case it happens to be just very wealthy individuals who are always transacting on something, or maybe it's a person that just refers a lot of business, and just trying to barrel down on those clients and focus on them a bit more. I think so many, I mean, like, you think of the volumes that some of our competitors-ish, but like big mortgage brokerages in the industry do. I mean, it's just unreal, like the kind of volumes they do, but yet they don't really sort of focus on the back end. There's no kind of real focus on what's happening in 2 or 3 years' time.
That absolutely blows my mind when you look at some of the larger agency-based ones. That
if you're doing shitloads of if you're doing shitloads of business 2 or 3 years ago, well, then you've got all those people coming up for renewal now. So it doesn't really affect it. So maybe they're not buying properties, but all those loans that you did 2 years ago when everything was good still exist. So
but what changed though, right? So remember at Alexander Hall, when we had the base rate was at 5% and lenders were pulling rates every Friday, just like now. We had this thing called urgency, or creating urgency. So for the last 5 years, there's been, other than the customer losing a property, there's been nothing to actually drive the sales process. But now you've got rates are going up, lenders are pulling products. You can sell things much quicker, much faster to customers, so you can influence the sales process. So that's another big advantage.
Yeah, as you say, it creates urgency. That's a good point, actually, because people need it. Before, if the rates were so low and people didn't really need to move money, that kind of thing, this actually hopefully creates more business. So,
go on. I was going to say, I don't really, maybe I'm just like ridiculously like cushioned and I just don't see it. I don't understand why it's bad now, right? Like, so you see these posts on LinkedIn of, I don't understand it. Like,
yeah,
so now it's good.
Been through a harder time. These guys, like I said, they have seen, this is a rate rise of 1.75%. So, which has been the biggest rate they've
you're
seen.
selling advice and a mortgage, like maybe in 12 months time, when everyone's like, oh, fuck it, I'm not going to buy any more property, I'm done with this stuff, and I've locked in for 5 years, so I don't have to do anything. Like that's maybe, but it's bad. But now is good, right? Like, now is, you've got a reason to phone someone and say, hi, like, base rate's gone up, that's bad, isn't it? Yeah. Right.
If you don't take this fixed rate today,
a bit more, but yeah, like, it's sort of
if you don't buy today, it's going to be more expensive tomorrow. Like, that's the best line you've got at the moment. Imagine Marcus said that to us. Imagine Marcus said that he's going to put his rates up by another 100 grand unless we do it today.
Gain on us,
We'll have that conversation offline. What do you think is going to separate people? Because there are going to be people that fall by the wayside, even though we know it's okay. Is it just your mindset, or do you think it's how people are geared? Because like you say, there are people moaning already. What's going to separate the guys who thrive and the guys who do okay and the guys that just fall by the wayside?
You just got to get on with it, right? You can't control this. You've just got to get on with it. I mean, if your business is set up properly and you've got kind of correct controls over what you're spending, your income, your expenses and everything, then you just got to keep going, right? That's it. You got to focus on the fundamentals, generate customers, do good work, deliver what you said you're going to deliver, try and charge a fee in between. You've got to keep doing that.
Easy business plan. That I might just go on LinkedIn for every broker. Do good business, charge a fee. It's really easy.
What else is there? Do a logo.
I think that certainly, I don't want to sort of like continue talking about fees, but it might be a time worth just reflecting actually on what people are charging. I mean, I think that's sort of a fairly important point, that down in the south of France, estate agents get paid 5% on a sale, like, so it's quite a lot of money on big figures. And again, sort of in the UK now, it's been a sort of race to the bottom, and it's kind of caused a bit of chaos amongst sort of everyone else. So maybe it's a time to reflect on that as well. I'm not too sure, but yeah, like I think it is sort of buzzwords of attitude and hunger and desire and all that kind of stuff, which is it's not really that useful, because you either have it or you don't, right? You can't like wake up and sort of have it. But what's that?
It is a cliche about mindset and that kind of thing, but it's true. Like if you aren't prepared to wake up and graft again the next day, you are going to fall behind. You know, it's just.
I mean, we've certainly benefited from. We've looked very closely always at the kind of the clients, you know, that do well for us. So we focus very heavily on that kind of, like you have said, that kind of top 5 or 10% of clients. Products that we do. So like kind of, Isla's obviously our marketing guru, but kind of it's fairly deliberate, right? What we post and the kind of deals that we do. We do quite a lot of deals as a business. You know, there's sort of over £1 billion worth of lending arranged each year through Enness. So, but we're quite selective in what we do, and that's obviously the stuff that we see as higher margin or maybe trickier to do. And I think also maybe just review in terms of like the easiest thing in the world is sort of to create, not the easiest, but it's fairly easy to create top line business, charge no fee, just pay away splits to everyone, pay your brokers a ton of money. Like you're going to make money, it's not a difficult thing, but sort of that bottom line is obviously what counts. And I think we had, it's probably about 5 or 6 years ago now, where we actually got rid of about 80% of our introducers, because we were like paying some of them, historic stuff from when we started and we were desperate, paying like estate agents 30, 40, 50% on deals. And it was just pointless. Like we weren't making any money. We were literally just buying revenue, and said, look, what we're actually going to do is just, the introducer model is fine, but I question how profitable it is. I mean, even looking within our industry, there are people who are linked to fairly large estate agency chains, and like if there's any kind of if you're paying away a third of gross revenue, it's pointless unless you're not paying your brokers any. So maybe review that. I mean, it's a fairly ballsy move to make, but within sort of what you in a downturn, but maybe just review some of those. And we all have historic clients where we just wish we hadn't agreed to that, done that, and it just keeps on biting you in the arse sort of month after month, year after year. So it might be sort of a bit of a life laundry session, but very much focusing on A, what you're charging up front, and B, probably what you're giving away at the back end.
Yeah, makes sense. Just in regards to that, because you mentioned spending, obviously we've seen some bizarre government advice about going into recession, about cutting your marketing and that kind of thing. What do you say to people like when they're cutting spending? Where do you look at first? If it does get tighter, where do you look at? Because I don't believe you guys look at marketing as something you cut. You can.
No, we spend a huge amount on marketing. I'd love everyone else to cut their marketing. I mean, no one really does any marketing really. They do a couple of case studies and everything. So there's not much to cut really, is there?
A few copies of yours on that.
They cut their quarterly email.
We were talking about this actually before you joined. We were talking about sort of marketers are saying there's an alarming similarity between some of the stuff that we put out and other stuff that sort of seems to the Me Too stuff. And we were talking about the case studies as well.
What I should have done is just set up a website company for mortgage brokers, and I could have just sold them. Save them the hassle of redoing it. I could just do it for you.
Save the hassle of copy and pasting everything off of yours.
Yeah, exactly. There's an art finance brokerage in New York I found, and they've put a bit of tracing paper on our website, copied it, went to it, or maybe screen print, maybe they're a bit more advanced, and just completely ripped it. But what can you do about it? Look, marketing is.
Actually, it's an interesting point. I was saying that to Hugh. You're supposed to find it flattering, but at the same time, you've pumped 15 years of your life into getting something right. How do you feel when you kind of copycat type?
I guess it's not really about the website. The website's one bit of 100 other things that's going on. It's tone and grammar and positioning and SEO and all these different things. So it's not as simple as just copying the colours and the words. There's a lot more to it. So what are you saying? What do we run quite a lean business anyway, because we focus on profit. That's the bit at the bottom, net profit. So that's the bit that's always been a kind of where we put our attention. Revenue, gross costs, what we spend, profit. So we've always focused on a kind of 38% net profit margin. That's what we aim for. And we engineer everything around that. So it's more difficult for us because it's not difficult. It's more because our deals are lumpy, 100, 200,000 pounds, and we don't do 50 deals a month. What do we do, Hugh? 30, 40, 50, something in that range. So it's more difficult for us to see when deals are going to land, especially now when lawyers and surveyors and lenders and everyone else are just taking ages to get everything done. But focusing on your profit margin and what do you have to do to hit that profit margin, that's the key thing.
You start from there. You don't start, your revenue's irrelevant in it. If you just, like you said before, actually, about buying revenue just doesn't.
Yeah.
I think we've certainly had years. I mean, now we're getting a bit more consistency in terms of, and probably, because we're barreling down on numbers on a more regular basis. But we've certainly had years where revenue has had no real correlation to what we've made, especially kind of during years. So it's a nice figure, but I don't really doesn't really bother me if I
as a business
up next year and made the money.
Revenue.
As a business, if you do a £100,000 deal and you pay 50% to an introducer, then you pay 60-70% to the broker, then you pay for your, electricity is expensive now, Marcus, and recruiters' fees are like going up like you wouldn't believe, and everything else. It's hard for us.
I didn't know your pain.
I don't know where I went with that. Exactly. You've got to do business that affects positively affects your net profit, not business that positively affects your revenue. You've got to decouple those things.
That makes sense.
I really appreciate.
Go on. Thank you.
You touched on sort of marketing costs. I think people have like it's sort of being smart for it as well. I mean, I can sit here in quite a smug position because I don't really have to touch any of it, and Islay just cracks on with it. But like it's sort of, you see this crap like people sticking adverts in the FT and kind of always paid for stuff, and these huge jollies or these massive fucking, I don't know, people going to whatever, like the Grand Prix at Silverstone and inviting 50 people for some outrageous cost. That's good, but it's just basic stuff that's just so dumb, right? Like it just eats cash.
Did you go through all the dumb stuff? Did you have to tick off all the dumb stuff off your list before you hit the sweet spot, or do you think? I mean, obviously,
there was a bit of vanity that went on, but I think we probably knew that it was just was exactly that. It was vanity. But I think we've never really, or sort of Islay's been fairly kind of specific in pointing out that we've rarely. It's pretty difficult to rival anything versus Google and some of the stuff that we do online in terms of like our newsletters and our sort of contact with clients, because we are an international business, but our clients are international. Like me going to Silverstone is a laugh, and I happily do it, but it's not going to grab a client in Asia or Africa or the Middle East or the Far East. So it's sort of we've maybe been quite lucky in that respect, in as much as that we know we've had to kind of get on the phone or get online metaphorically to grab clients.
Yeah, good, and that all makes sense. I do appreciate I've taken up loads of your time, and you're both away from the office at the moment, so again I really appreciate it. So I'm going to finish with maybe it's a cheesy question and it probably can't be answered, but I'll finish with, can you recession-proof your business? Not you personally.
No, I think the minute you start trying to do that, you're putting yourself into a position where so if you start cutting stuff in anticipation of a recession, then you're cutting all the things that makes the business good, and then the recession will come and it will then end, and then things will kind of accelerate again. And if you've cut everything out of your business, you're just limiting your ability to take advantage of, first of all, in a recession there's change, and that's a good place to do deals and make money and find avenues and find opportunities. So recessions have opportunities, and then when a recession ends, there's another big opportunity, because all your competitors that have cut all their marketing and fired all their people and shut their offices down, they've got to build that again. So if you can retain all of that, then you're in a much stronger position.
You come out the other end with a bigger market share than when you went in, because it makes sense.
Yeah.
And your answer, Hugh, was yes, you can.
I was literally just, I was keeping it short and simple.
It's dinner time. It's dinner time in Dubai. He's pretty hungry now.
I don't need from a set. Okay, so look, yeah, okay, I'll agree and disagree. I think what was interesting was to how I work it. But when COVID hit, actually, it's quite funny, and Isla and I do refer to this document on a fairly regular basis. That, like everyone, we kind of thought the world was going to end. I mean, I was a little bit dubious that everyone was going to die, but I did think they might lock us up in a house forever, which might cause a few headaches of people getting mortgages. So we had like a kind of a daily spreadsheet, like an interactive spreadsheet, where we literally listed all the deals that we had, which I think anything above like 50k, which was completing. And there was like a daily focus on, right, like what needs to be done on this deal to make it happen. So I think fairly early on, we identified that valuations would be an issue, right? So even if a bank wanted to lend, if they couldn't value it, that was an issue. And we also had like a sort of battle plan underneath that. So I'm going to agree with Isla in as much as I think in terms of if you're running a good business and you're sort of and you're in good shape at the moment, then probably continue what you're doing and continue more of what makes you good. Whereas I think if you spent all your pennies or there's a problem there, then probably you do want to sort of get down to quite a granular list of this shit needs to get done and quickly. But I think that's I honestly think it's in 12 months time. Like I think now is a phenomenal time to run a business that we do, because everyone's just charging for debt at the moment, as far as I can see. I think you're a little bit premature, Marcus, is my feeling in this.
You don't know when this is coming out. This is coming out in 12 months. I'm so far in front of my website.
When Enness was like bust and finished and everything, and we're here. When we're like dead and buried in the ground, and it's like,
the other thing, the other thing about timing is our other business, 10, the bridging lender, right? So again, we launched that in the most competitive bridging finance market that's ever existed, right? And we found a niche in that business, which is high value individuals, high value property anywhere in the world. So we're doing loans across Europe and Bahamas, and we had an offer in Mauritius and everything else. So that was built with its purpose and with its niche. And then all of a sudden, bridging lenders are having their credit lines pulled. And as the base rates increases, all of those very skinny margins that the bridging lenders were happy to take is now being eroded. So 10's now found an incredible position because our cost of funding in that business is relatively stable. So look, when is the worst time to start a business? Next year, right? Because you missed this year. Yeah. So just get on with it, I think is the point. And don't matter how much kind of recession propaganda Marcus is pumping out, just ignore the noise, get on with it.
Kind of ruin everyone's businesses, yeah.
Just ignore the noise, get on with it.
That's a great way to finish. Just ignore it and crack on. It makes sense.
Yeah.
That's what I'm trying. I love talking to you. Say again, sorry.
I was going to say, whatever Marcus is worrying about at 3 o'clock in the morning in the gym, just ignore about it. Just get on with it.
It's not the recession. No, because I genuinely think, like you, we've picked out our A clients who talk like you, who love the opportunity, who can't wait for the challenge. It's still going to be challenging, but I just think that's who you have to surround yourself with. So I think we've done the right thing. So I'm not actually panicking. I'm just making sure all those mid-range brokers don't start running away. But that's really useful. I really appreciate your time, like I said, and those listening on Spotify, watching on YouTube, appreciate your time. And if you've got any questions, by all means ask me, and I'm sure I can pass it on to the chaps, and they'll be happy to answer any questions. And thanks very much. I appreciate it, guys.
Thanks, Marcus. See you later.
Cheers, Marcus.